Cool. Hey guys. So my name is Jack, and I'm one of the co-founders and CEO of Checker. What we built here at Checker is operational infrastructure for digital assets, specifically for stablecoin payments providers. But today I'm not here to sell you my product or my company. I'm here to talk about what's going to happen next with stablecoin and payments. So to begin with, let's just start with the context and the facts and figures, right? So stablecoin definitely is proven to be the killer app for crypto, hitting 160 billion of onchain capital. And actually, this chart I took it from Nick Carter's report. Nick is a good friend of mine, and he's very generously sort of done all this research in his report. And specifically, what's happening for the past few weeks is definitely the landmark deal that Stripe did to acquire a stablecoin on-off-ramp company called Bridge, based in the US. It's definitely proven that a traditional fintech, what we call traditional fintech, company like Stripe is now making headway into the stablecoin space. So stablecoin is now no longer the fringe sort of applications for crypto Web3 weirdos. It's now entering into the Silicon Valley main street. Now, how do we contextualize all these developments in crypto payment space, right? So in my opinion, if you look at sort of since 2017, 2018, that was the first wave of crypto payments. Most of them focus on conversion between cryptocurrencies and fiat. So companies like MoonPay, Ramp, Transact, right? And those are usually targeting retail users. So people that want to buy NFTs, people that want to buy DeFi tokens. And it's mostly fueled by speculation as well. And as you can tell, right, so the widget on the left, that's a MoonPay widget, and the screenshot on the right, that's the OpenSea marketplace. And that was the dominant use case for the past DeFi summer, right, 2020, 2021, and even till the bottom of 2022. But what's really interesting now, since 2022, coming out from the bear market, from FTX and Celsius and BlockFi, is now we see a second wave of crypto payments companies. And the types of use cases and the users that they target is very different from MoonPay, Transact, and RAM Network, etc. So taking this chart from Artemis stablecoin map, you can see there's different types of companies focusing on different use cases, right? So you have remittance use case, you have payroll use cases, you have B2B payments use cases, and very different from 2020 wave or first wave of crypto payments. Most of these companies, they do not use Bitcoin, Ethereum, Solana, Ripple for payments. What do they use? They use stablecoins. And to be honest, mostly they use USDT and USDC. Now, Bridge is, by the way, one of the examples in the US specifically, focusing on B2B payments. So how do we explain this first wave to second wave evolution of crypto payments? So in my opinion, if we look back in the early 2000s, in the dot-com bubble era, on the left, you see there's a bunch of subsea cable. So the fact that you can now hop on a Zoom call in Hong Kong with the US with, sub-second latency, that was thanked to, the dot-com bubble, trillions of money being thrown in infrastructure. And in a similar way, in my opinion, to the right, you see these crypto native exchanges. They build an infrastructure for on-off-ramp, right? And the users mostly are just buying Bitcoin, on-ramping with fiat. And then sometimes they make money in shitcoin and meme coin and they want to off-ramp into fiat. But that subsidizes the liquidity for, Mexican peso or Brazilian Rio or HKD to USDT pairs. And it makes it really cheap for you to on-off-ramp. And so because this speculation brought wallet adoption for crypto retail users as well, right? So what's going on is basically, let's face it, this is a unintended good consequences of bad applications of crypto, right? Because of the casino nature of crypto, now we've brought all these base layer infrastructure. Now, in Web2 fintech, a wave of startups, they try to offer what's called banking as a service, BaaS, for new applications to build on top. So as you can tell on the left, that's the traditional fintech infrastructure, right? And so you have companies like Venmo, Wise, Cash App, Affirm. They all benefit from banking as a service. And new types of P2P payments come out on top. Now, how is stablecoin as infrastructure different how are all the companies in the map that I showed earlier different? Well, now they are leveraging this open network for distributing the liabilities of these stablecoins. And that has actually proven to be prosperous for the whole ecosystem. And so now what you see in the world, you have hundreds of, stablecoin focused payment service providers in different regions, South America, APAC, Africa, MENA, right? And this is mostly an emerging market story, right? This is not happening as quickly and as broadly as we hope in the US, in Europe, to be honest. And most of the use cases, they're very legitimate use cases, right? They're not speculation driven. They're not buying Bitcoin or trading meme coins. They're e-commerce, remittance. They're getting access to the dollar banking system. And why are these PSPs doing it, right? So our thesis is because these PSPs are now unbundling correspondent banking. So in the traditional SWIFT, right, instead of doing a traditional SWIFT banking network, you now unbundle each leg of the transaction. And now all of the logos that I show you in the global map earlier, right, they all specialize in one portion of each leg of the transaction. And just to set the context right, so I'm not talking about sending money from US to Europe. That's pretty much solved between developed markets. What I'm talking about is from emerging markets to developed markets. So imagine from Africa to Europe, from South America to the US, or South America to Europe. And these are where SWIFT is still, 2 to 3 hops away, right, resulting in, T plus 3, T plus 5, 3 to 6% of tick rates. So what's the next logical step? It's going to happen with payments and stablecoin. In my opinion, very similar to how SWIFT develops correspondent banking that connects all the different traditional banks for them to trade with each other. What's going to happen with hundreds of these payment service providers globally that are specialized in fiat and stablecoin conversion? Well, there's going to be a new type of correspondent banking relationship between all these PSPs. And that is the topic that excites us a lot here in Checker. What is the new type of network that can connect them all and to rebuild a new type of SWIFT? Now, one of the most important questions to think, to be intellectually honest, is what would the incumbents do? So many of these incumbents have already built infrastructure, banking relationships, liquidity that competes more or less with stablecoins. And so one of my predictions is they will either compete or they will co-opt. And so they will use stablecoins as a back-end technology for them because it offers startups much quicker way to leapfrog and go global with this new type of correspondent PSP network. Now, lastly, I want to end with a prediction or some sort of area for potential where I think people don't really discuss. To be frank, most of payments is, you can summarize it as pay-in, conversion, and payout. It's a 3-step process. But there's a lot of pain points surrounding contextualizing the workflow. For example, what is the payment for? And once the transaction is done, you need to do the accounting. You need to do the calculations. And once you receive the transaction, right, you need to combine your invoice with that transaction. And this, in the traditional Web2 space, right, that's the sort of CFO toolkit, companies like Bill.com, hundreds of billions of market cap. So in my opinion, right, Circle talks a lot about programmable money. Unfortunately, we don't see really any adoption at all, right? Most of the payments is still between centralized parties. But as the new type of correspondent banking relationship develops, right, then maybe things like escrow payments or programmatic transfers or even payments between AI agents, right? Those are going to be done via smart contracts or on a blockchain or via, new type of correspondent network. And this opportunity, it's going to be huge because that means that Web3 now can stand with companies like Bill.com, Ramp, Brax, etc. So very quickly, I'm going to introduce why I'm here talking about this and why we're excited about this opportunity here, right? So background for Checker. So what we build, like I mentioned earlier, we build operational infrastructure for payment service companies, and specifically we deliver them a unified API for them to automate the middle and back office. And our team, we used to run engineering, trading operations at Wall Street and crypto institutions. So Tower Research Capital, Morgan Stanley, Abra, Galaxy Digital. And then we're also supported by operators in the capital markets and payment space, so the likes of Plaid, QED, eBanks, and SSNC. So if what I talked about today excites you, new type of corresponding relationship between payment service companies, new types of use cases of using stablecoins to send money abroad, feel free to reach out to me and have a good conference. Thank you.